Good afternoon and welcome to the AUGMENTUM FinTech PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated on the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to Tim Levine, CEO. Good afternoon, sir.
Good afternoon, and thank you everybody for joining this investor presentation. It's fantastic to have so many investors who are able to join us. I'll spend the next 25 minutes or so just talking you through the headlines of the results that we have just issued this morning, which for the period ending 30th September 2022. And then we do have a Q&A, so please do type in those questions at any point, and I will do my very best, time permitting, to answer as many of those as possible. So without further ado, let me get started. I have more slides than I will be talking you through, but the presentation will be available on our website, augmentum.vc, at the end for you to download. So feel free to go there as well, so you can look at it in more detail. I think the key headline that I would like our investor base to leave with today is we have endured over the past 6 to 12 months a very difficult macroeconomic backdrop, alongside what is clearly been a sell-off in risk assets globally, both in tech and fintech. And I think despite those challenging macroeconomic conditions and that resetting of the perception of valuations in the tech and fintech market, we've continued to deliver a really robust set of numbers. So in terms of the net asset value, that has remained stable along with the NAV per share. The underlying growth in the portfolio remains strong, and I think as importantly, we are well capitalized in terms of our cash position. Traditionally, we would not want to be holding significant amounts of cash to avoid the cash drag. Nevertheless, it is important for us in this environment to be well positioned to capitalize on what we believe will be a compelling market in 2023, where valuations will continue to moderate. And we feel we are in a strong position with our pipeline and with our embedded relationships to be able to invest further beyond our existing portfolio. So in terms of where we have got to in the portfolio, over the last 4 years, the objective from day one was to build a truly diversified fintech portfolio. What do we mean by diversified? We want to ensure that our investors have exposure across some of the most exciting and emerging subsectors within financial services. And I think you can see here, when you look at the 24 businesses across our portfolio, it's across a number of those areas where we have had both deep domain expertise, but also a clear thesis that these are areas of continued disruption and will present continued growth opportunities over the coming years and beyond. It doesn't mean that we are going to stop at what you see now. There are a number of subsectors where we continue to focus, or even within these sectors, payments being one example, where we're continually looking at compelling opportunities in that space where we can expand our exposure. And in terms of progression, for those that have been a shareholder either more recently or since the start, it has been a continued steady progression in terms of growth, both in terms of NAV, but also in terms of our deployment. As we've always discussed since 2018, an IPO, the strategy of AUGMENTUM is to help scale early stage, high potential businesses. And over time, those success stories should deliver compelling returns. And we saw that in a significant way at the beginning of this reporting period with the exit of Interactive Investor, which delivered 11 times return on our capital, which was an IRR of over 80%. So we need to deliver these success stories over time to deliver what we would talk about is our internal rate of return. So what does that mean? Our internal target is to deliver over the long term a 20% annualized return in our deployed capital. That would put us in the top decile of performance. If you look at our performance to date, it kind of fluctuates either side of 20%, but largely has stayed on track in terms of what we think is achievable and what really would define a tremendous kind of success for ourselves and our underlying investors as well. So what have we been doing over the past 6 months in particular in terms of deployment? And it probably comes as little surprise to say that we have not been deploying as actively as we have done in previous periods. In fact, if you look over the previous 12 months, the rolling 12 months, we've deployed about half of what we did in the 6-month period from March 21 to September 21. Well, why is that? We recognize that the market has pulled back. We recognize the value of being long on cash in this market to make sure you can capitalize on the inevitable market opportunities that we see likely to come down the pipe in 2023. But also we need to be able to identify not just compelling companies in the fintech space, but also compelling investment opportunities. And I think that is where the balancing act has been struck. And it is our view, certainly in the last 6 months, that yes, we continue to see a number of interesting fintech companies, but we did not believe enough of them represented compelling investment opportunities and were going to reward us for the risks that we were prepared to take in order to deploy that capital. And as such, you've seen light deployment with only one new company being added to the portfolio, and that is an Israeli-based payments business called KIP, which we invested in a few months ago, which is really espouses a lot of the characteristics of the type of company that Augmentum is looking to back. In particular, at the early stage, a business that is targeting a big market opportunity, a business that has very strong domain expertise, strong capabilities amongst its founder teams. And if they do deliver, then they can build a very significant business. This is not something that is a me too. This is something looking to do truly something differentiated in the payment space to reduce the number of false positives that merchants are getting. And their technology really is showing some very exciting early signs. And that is really our role as a deep domain expert, to get access to some of the most exciting emerging opportunities in the fintech space, predominantly across Europe, and increasingly we would include Israel in that, with the amount of innovation, in particular in the B2B fintech space that we're seeing in that market. It is our job to be ahead of the curve. It is also our job not to be right too early. And it is about making sure where you can over the long term that you are right more often than you are wrong, to allow you to kind of drive those ambitious returns. So when we talk about the portfolio and we talked about the diversification, what's equally important is that diversification across stage. And what do we mean by that? This is not a portfolio of companies that is all about future potential, where we're taking significant early risk. Of course, one of the key attributes of being a venture investor is to seek outlier returns, but also to take risk. We do not expect all of our companies to succeed, or certainly to succeed to the extent that we would hope they would. We have to be prepared to take risk, and we have to be prepared in some cases to see these portfolio companies fail. But as I just said earlier, it is important that we identify enough of these winners to deliver that return. And you're starting to now see the evolution of maturity in that portfolio, where you have a number of assets where if you'd have looked at our portfolio 3 or 4 years ago, the likes of Grover and Tide and Onfido would have been in that early bucket. And they've really kind of broken through. They've broken through where they've demonstrated strong product market fit, where they have really built scale, where they have cut into incumbents' market share and have real momentum. Now, when we talk about a late stage business, it doesn't mean that these are tired, sleepy businesses. These are businesses still growing at a fair clip. In this particular case, the year-on-year growth for the first 9 months of the year of our later stage assets, our more mature assets, is at 45% year-on-year. And that's despite what we talked about being a difficult macroeconomic environment. These are businesses growing despite the challenging backdrop, and in some cases will thrive in what will be inevitably over the next 12 to 24 months a difficult macroeconomic environment. And we continue to expect to see some of these businesses in the early and the mid really move down into the later stage. And that is where the realizations should come over the next 2 to 3 years. That's what you should be looking at, saying, where I look at the NAV today at 155, where am I going to see that growth per annum of 30p in NAV growth? And I think you will see a lot of the tangible realizations come from that cohort of companies, but some of the NAV growth also to be coming from those earlier stage businesses too. Now, I think what is really important in an area of deep interest, and when I talk to a lot of investors, they are really honing in on valuation. They really want to understand, what our methodology is. Can they really get comfortable with the NAV that we are issuing? And I think we've done a good job over the past 6 months, really giving a more granular level of detail. And you can see here, as an interim set of results, there's constant movement amongst the portfolio in terms of how we and our auditors are attributing valuation. That will carry on, and that will be reflective of a number of factors. And if you look here, we talk about the different valuation approaches that we take. Of course, you have to look to the public markets, as we use many comparables in those listed markets, both in the US and in the European markets too. And as we know, those public market multiples have reduced significantly, and that has been reflected in the valuation of our underlying portfolio. Alongside that, some of our businesses have raised capital through new funding rounds to help fund their growth, where external investors will come in and look and price accordingly, of course, taking into account the prevailing market conditions. And that will also be overlaid into certain companies within our portfolio where that has happened. I think the final thing to say and to explain is, when we talk about downside protection, what do we really mean by that? And we talk about two key dynamics, two key attributes that are in most of our structures. One, we would put in our term sheets and we would expect to receive a preference share. What does a preference share mean? That means if a company raised 5 million capital from us at a valuation of 25 million, and in a scenario where things didn't go to plan and the company was sold for 5 million, our preference share would sit above the ordinary shares, and we would receive our 5 million pounds back, even though the valuation might have reduced 80 to 90%. And that is a really important feature, because we are backing, in some cases, big visions, big dreams, and we might pay a higher headline price in order to get access to that. And if you find an exceptional management team, founder team that can deliver on that vision, then you and they will be well rewarded. It doesn't always turn out that way, and as such, where we can, we want to ensure that we're protecting our downside. Alongside that, the anti-dilution structure gives us some protection, where if there were further shares issued at a lower price to what we invested in, there would be further issuance of stock to us to make good that dilution that was experienced. And those key structural attributes are incredibly important, and you'll see the majority of the portfolio would have those. In those 4 assets where we don't have that, 2 of them have been significantly de-risked actually as they're profitable businesses, so our downside risk is much lower, and 2 of them are actually fund structures where it isn't appropriate to or possible to put those structures in, but the underlying assets in many of those portfolios would have the similar structure. So we do feel that we have that downside protection, and at the same time, how we value our businesses, we have taken a pretty prudent, robust and conservative approach relative perhaps to some of our peers in the wider venture market. So why do I say that? And I think when you look here, this chart, the orange line is what the listed fintech index was trading at in terms of forward revenue multiples over the past 2.5 years. So we all recognize that in 21 in particular, and at the end of 20, the listed tech stocks went on a hell of a run, in many cases at unprecedented levels. For us, throughout that period, when you applied our valuations to our top 10, of course, we looked at the listed markets, but we felt very uncomfortable with the multiples that were being attributed. And we were reluctant to apply those same multiples to our underlying portfolio. And you can see that. You can see our average over the last 2.5 years in terms of the forward revenue multiple of our top 10, which grows on average about 3 times this high growth listed fintech index. So these are businesses that, albeit earlier, but still growing at a quicker pace, between 4 and 6, and actually the current levels at 4.2. So the listed market has come back to the long-term historical norm, which we estimate to be about 6 to 8. But at that whole period, I think it's fair to say that we held our discipline, and we can very much stand behind the underlying methodology and approach that we have on valuation. And I think when investors ask me, why haven't you written down your values 50, 70% to the listed market? I think the honest answer is we never wrote them up anywhere near to the extent that we saw in the listed markets. And in parallel, these businesses have continued to grow at a healthy rate on average. So what does that mean? So why is our NAV flat, despite the fact that I'm talking about growth? And I think here is a chart that really hopefully effectively demonstrates what I've been trying to articulate over the past few minutes. So here is the core portfolio, which has Interactive stripped out because we've exited that now sits in cash. When you apply the impact of growth in the portfolio, that added another 63 million of implied valuation change. But we looked at the markets, we looked at what has happened, and we contracted the multiple. And so the credit of that growth was negated by the reduction in multiples that we applied across the board to our portfolio companies, which at the end of the day, after you bring in some FX impact in the portfolio, gives you a largely kind of flat position, which has led to a stable NAV of £1.55. And when you get under the hood one level deeper and you look at the top 10 assets and you sit there and say, okay, well, let's really understand which of them, maybe it's just one asset that is growing and that is distorting the picture. It's actually quite different. Fundamentally, when we look at our top 10, which accounts for 3/4 of the NAV, you have businesses that are growing at a really kind of healthy clip on average at all kind of stages in terms of the scale. Yes, we have some of our emerging businesses, the likes of Intellis, based in Switzerland, Anyfin in Sweden, and Cushion in the UK, but also some of our established businesses are really growing very well, whether it's Zopo, Grover, or Tide as well. And I think that's really encouraging. Alongside the fact that you will have seen our deployment over the past 6 and 12 months has not seen significant amounts of capital go into the portfolio. And that is because they are well funded largely. and they did raise significant amounts in many respects in 2021, and have made sure that they've looked at these market conditions and extended their runway where it makes sense. And they are well capitalized in many cases over 2023 and beyond, in some cases towards the end of 2024. Now, I'm not going to dwell specifically on some of the companies, but there is some kind of specific information which will leave you to go through at your leisure. But I think it's important, before I go to questions, to give you a sense of what we're seeing in the market, both what's happened and what we think is going to happen over the coming year or so. So it's fair to say that 2021 was an anomaly in the market, and this really highlights it, the chart on the left that shows you the amount of capital that went into fintech globally. And I think those charts will be reflected if you segmented that by Europe as well. We would have had a record year in Europe. So 2021 was an outlier year where a huge amount of what we would define as first-time tourist capital came into the market, not specialist investors, seeing fintech as a huge market opportunity, late to the game, wanting to get exposure at any price. That inflated the market, that created a dynamic where funding rounds were bigger than they needed to be, where businesses were taking more capital at an earlier pace at a time when they hadn't proven out what we would have expected to be fundamental performance metrics, and that did distort the market. We would argue that that market is even more of an outlier in 2021, because a lot of the capital that you see here in the first 9 months of 22 actually was a lag from the end of 2021. So we'd argue about half of the capital in 22 really should be attributed to 21, but due to data being released late or deals that took a little while to close legally, that has rolled into 2022. The true picture of 22 is far more, I think, akin the second half of 22 to what we've seen historically, reverting to the norm. Our focus tends to be at the earlier stage. We don't really invest in the seed or the pre-seed. We like to invest at the Series A, where there is product market fit, where there's a proof of concept, where we can get into the data and get a reasonable level of comfort, albeit still with a huge amount of execution challenges. But there is enough meat on the bone to give us confidence that this is a business worth backing. A lot of this capital came in at the later stage, which really inflated the valuations. Now that has come off significantly. The earlier stages have remained more resilient, but at the same time hadn't seen quite the same levels of valuation appreciation that these later stage rounds had experienced. So who was deploying a lot of this capital? I think this is a fascinating chart. When we look at the most active venture investors in the first 9 months of 21 and we compare it to the first 9 months of this year, actually, almost all of them weren't venture investors. Many of them we hadn't come across in our space before. Large hedge funds, sovereign wealth, who were looking to enter this sector. And you can see here, in most cases, the dramatic reduction in their activity. And I think we'll see a lot of that activity continue to erode. And the market will revert back to those longer term, deep domain experts who understand the asset class, are here for the long term, and are looking what we would define as real alpha, not just pure beta. We are looking to deliver differentiated access to our investors. And as the only listed fintech fund in the UK and one of the only globally, we do feel that we offer retail investors and institutional investors in the public market a very differentiated set of skills and assets that others will struggle to find the opportunity to get access to. So what about the IPO market? I often get asked, well, how are you going to exit these businesses? The IPO market is closed. We're not going to see these realizations flow through. The reality is the vast majority of exits in the fintech space will happen through M&A, either through strategic buyers or through private equity or other kind of asset managers that would look to buy these assets. That is the fundamental dynamic. Even in the standout banner year of 2021, we saw a buoyant IPO market, but we saw an equally buoyant M&A market. And fundamentally, the vast majority of exits in 22, 23 and beyond will be through M&A, and that will be very much the case, even though we do expect in 24 the IPO market to start to return. So what else are we seeing? And this is a sector that I've been around in as an entrepreneur and as an investor for north of 20 years. So I've seen 3, maybe this is my 4th downturn. So we've ridden this rodeo many times before. What we saw in 2000 was, in the European venture ecosystem, a total disappearance of capital in the market for the next 2 or 3 years. We are nowhere near that situation this time. The European venture ecosystem has come a long way in the last 20 years. The UK venture ecosystem is night and day from when we built Flutter and Betfair back in the early noughties. There is more dry powder in the European venture system than at any previous point. So that means that the capital is there for high quality tech, fintech businesses to be able to scale. And that is incredibly important, because it is critical that our high quality fintech businesses attract high quality investors to help scale them on their next phase of the journey. It is our job at Series A, at the Series B round, to help underpin their growth. But beyond that point, we will be looking to a different type of investor with a different profile, with deeper pockets in terms of the capital that they would have to help these businesses scale. And we see a lot of high quality investors still in the space, and with the desire to invest, which we expect to see in 2023 and beyond. And what about the incumbents? Well, the incumbents in the financial services industries have spent enormous amounts of capital over the past decade in digital transformation, a large amount of which has proved pretty ineffective. You are trying to turn around slow-moving oil tankers that find innovation very hard to do from within. And yes, they will continue to invest heavily on their balance sheets, which are hugely emboldened in the current environment. So $2 trillion of cash sitting on balance sheets of the top 5 US and UK banks. So it is our view that they will continue to invest directly from within, but they would continue to invest directly in fintechs, and at the same time become increasingly acquisitive, which we've seen as a trend over the past 2 to 3 years. And that is a trend that will, in our view, grow. They will acquire assets that they feel give them a real strategic advantage, in parallel with reducing the competitive threat that these fintechs could provide, or the threat of a competitor getting hold of the IP that these B2B fintechs are building and developing. And this is certainly a trend that you should keep a very close eye on over the coming 12 to 24 months. So let's separate kind of the valuation dynamic to the market opportunity. So why should you be a believer in the fintech opportunity in the UK, Europe and beyond? The reality is, you are looking at a market that has enormous revenue and profit pools, $14-15 trillion of global revenues to attack, depending on how you define the market. And when you segment this market by subsector, whichever one you look at, when you look at the penetration of disruptors, it is still surprisingly low. Now, we've already seen hundreds of businesses in the fintech space already get to scale. But when you are a small piece of an enormous market, you can build a very valuable multi-billion-dollar business in many respects. But there is a long, long way to go. And we would expect these penetration rates in 10, 15 years to be 4, 5, 10x in the insurance case at the levels we're seeing today. So there are going to be a significant number of very valuable fintech businesses built that are just starting to be built today or are yet to be built, in our opinion, over the next 5 to 10 years. And it's our job as a specialist, deep domain expert in the space, to identify enough of those high quality businesses for our investors to deliver that compelling return that we talked about earlier on. So what's been happening in the pipeline? What's coming? We're sitting on 57 million of cash. How quickly are we going to deploy it? I think the one thing to say, our bar has always been exceptionally high. Our conversion rate has always been below 1%. It is even lower at the moment because in this market where pricing has been challenging for us, where others have been prepared to pay a price that we've simply not been prepared to pay, and I think with the benefit of hindsight, we are happy that we took that approach. Our conversion rate of companies that we're engaging with to actually investing is at 0.1, at its lowest ever level. We would expect that to increase over time because we're expecting pricing to come back to more reasonable historic levels. But at the same time, we are absolutely prepared to wait and be patient. And we talk a lot about a good fintech company isn't always a good investment. And that is really important that we maintain that discipline and patience. But we continue to see a large number of companies that are looking to come to market next year. The pipeline is significant, and we've nurtured these relationships over the past decade. And those are the ones that we'll be looking to leverage, with the team to capitalize in 2023 and beyond. And where might you see some of this focus? Well, this isn't an exhaustive list, but here is kind of opening a little bit our treasure chest of ideas where we've been focusing as a team on the bottom-up approach. What are the trends that we're seeing? Where within these enormous markets, payments, which has been a hugely disrupted space already relative to other subsectors, but still remains horribly inefficient and incredibly attractive in terms of revenue opportunities. And I think the likes of KIP demonstrate why we still see compelling potential in certain areas in that arena. Again, the insurance space is one of those areas where if you looked at our pie chart early on in the call, you wouldn't have seen exposure. We still fundamentally believe that there is a massive market opportunity there. We have yet to see, in our view, a company that we could get comfortable with, not with the disruption that they were bringing to the market, but with a deal structure that we could be comfortable with. And often it comes down to pricing. But there are some certain areas within that space, whether it's in the claims management space, in the B2B space, or even in some really emerging areas such as cyber insurance, which we think is an emerging theme that is of real interest. It's our job to really identify some of those emerging talented insurtech businesses in Europe and see whether we can get comfortable to get these opportunities over the line. So here's a brief snapshot of some of the ideas and themes that we're following and tracking across the investment team. So in summary, what are the takeaways that I'd really love you to go away and reflect on? Fundamentally, the opportunity is still meaningful and early in the journey. For those cricketing fans out there, I would say we're halfway through the first innings with a team that won the toss batting first. So there is a long way to go. As a fund, despite the huge unpredictability and volatility, we've really remained disciplined over the past few years. The portfolio has proved resilient. It has grown despite a difficult macroeconomic backdrop. The valuations have remained steady during a period where we saw huge valuation inflation in the market, but we did not fall victim to inflating our valuations at the multiples that we saw in the listed market. And in our mind, we continue to take a prudent approach. And when you look at a NAV of £1.55, we're confident that we see a real upside from that over the coming years with some highly strategic assets in our portfolio that we hope will continue to grow in a sustainable way as we have seen over the past 12, 18 months and beyond. And this is a time where we also believe that the quality should rise to the top. We are here for the long term. Our investors recognize that venture is not an overnight success story. We are looking for exceptional companies with exceptional teams that can deliver long-term, high-quality shareholder returns. It's our job to see as much in the market as we possibly can, and then when we see something truly exceptional, try and find a way to deploy some of our capital into that company. And our capital at the moment is weighted towards cash, where about 20% of our NAV is sitting in cash, and that is a very deliberate strategy. And alongside that, we have no debt. There is no leverage in our portfolio at all. So what you see here is cash and no debt, and I think that's an important feature to echo. So I'm going to stop there, talk for 30 minutes, and hopefully that has given everybody a pretty good appreciation of where we've come from, the dynamic in the market, what we're seeing, and the approach that we have taken over the past few months. So I'm going to take a look now at the questions, and let me kick off from the top. I'll just take these in the order that they've come in. So the first question was, what gearing does the company currently have? Well, I've just answered that. There is no gearing. So I think hopefully that does. And how does that compare with pre-COVID times? We never had gearing. So I think that is hopefully a straightforward answer. In terms of the next question from Steve, how do you account for the market price versus the NAV? I think we're talking about share price. I think the one thing we can't control is share price. Clearly, at the discount that it's at, we're pretty frustrated because we think it's not reflective of the quality of the underlying portfolio. It is not reflective of the discipline that we've had in our valuation approach. But ultimately, there is a narrative in the overall market that is negative towards growth and tech. And I think everybody is being tarred with the same brush. And I think it is our job, and maybe we need to do a better job to articulate why we're different, why we believe that we should move not only back to par, but we should trade at a premium, which if you were here this time last year, we were trading at a premium. And I think and hope that our continued strong performance, the quality can shine through and we can be rewarded with that. If I look at the volume of trading, we're not seeing institutional selling amongst our shareholder base. We do see some retail selling on light volumes, and that does, I think, exaggerate the drop. But I think we remain, very confident, very comfortable with the underlying portfolio and with the potential that it has over the next 2 to 3 years. I think, as importantly, I alluded to it, there's a lot of what we think are really strategic assets in there, and I think and hope that they will really kind of come to the fore over the next 12 to 18 months, and hopefully the performance will play that out. Question from Miguel. You've mentioned the multiple contraction as a negative factor in there. Is this playing in your favor in terms of investing? Can you find attractive investments at lower valuations? Absolutely right. I think one of the reasons you've seen us turn down the dial in terms of deployment is we absolutely believe that will start to play out. It hasn't played out so far in any material way, and that's because you have what I would classify as the bid from the investors and the offer from the founders, the fintechs. They might be lost in 2021 and we're in 22. And I think that will narrow, and it is narrowing. And I think we will see that narrow to a point which makes us much more comfortable in 2023. I don't have a crystal ball. I can't tell you it's going to happen in January or in June. But we're starting to see a dose of reality back in that market. And I do think we will find attractive investments at what we think are much fairer and more moderated valuations. Question from Nick. Augmentum has modest exposure to the digital asset space. is the current meltdown in crypto an investment opportunity or the final nail in the coffin for crypto? Yeah, it's a very pertinent question, and one which we internally have been talking about long before the events of recent weeks. And I see there's another question below, so I'll answer the crypto and digital assets questions together. The question is from Chris, saying, given the disruption in the crypto market due to the collapse of FTX, can you please comment on the impact of Gemini? So I think if you read our commentary in the past on digital assets, we have moderate exposure. We have focused on what we believe is the institutional infrastructure layer. It is our view that you need to separate speculative crypto tokens to the underlying technology of the blockchain, where there will be, in our view, some compelling use cases at scale over the coming years. However, we have always recognized that for the industry to have a long-term viable future, it needs to embrace regulation in the right way. And the reason that we backed Gemini was when we sat with the team and really understood their vision, we said they are looking to build a long-term proposition which has regulation at the heart of it. It may surprise some of you that we did meet FTX and we have met, as is known, SBF and his team in the earlier days of their evolution. And we did not invest in the business, I'm pleased to say. And we saw many of the challenges that ultimately brought it to its knees in our conversations with them, where we were uncomfortable with their approach to regulation. And that really is what led us to work with Gemini, which we believe is well positioned for the long term. So we want to make sure that we are giving our investors diversification, and we think digital assets is an important part of that. But this is far from being a digital assets fund. You are never going to get exposure to exotic tokens through Augmentum. That is not our job. We'll let investors speculate on their own ticket and through their own accounts. We want to continue to invest in the long-term infrastructure, but it's going to be moderated as part of our overall diversification strategy. And I think that is playing out so far. Yes, in some cases, we've kind of written down some of our investments in the digital asset space, and I think that, again, is prudent. But, it is an industry that still has significant promise, and it's our job as a fintech investor to really look at what's coming down the pipe, not just next year, but over the next 3 to 4 years. And I think we'd be doing our investors a disservice if we didn't have what we think is a thoughtful, diversified exposure in digital assets amongst some of the most credible long-term experts in that space. And I think we're giving our investors a good breadth of exposure, and hopefully the test of time will allow that to play out. Question from Miguel. Are entrepreneurs behind the projects you're interested in aware of the new market environment, or are they still fixated with valuations from a year ago? I've had lots of conversations with entrepreneurs. And one of the things, having been an entrepreneur and still very much an entrepreneur, is we are eternal optimists. But at the same time, you also need to be a realist. And you can't look back. And if I think about entrepreneurs that are saying, well, if I was raising money back in 2021, I would have got X. It's kind of irrelevant. The market will speak, and the market is speaking now. And ultimately, the right price, we think, will be arrived at. And when you don't have this fire hose of tourist money distorting the market on pricing, then I think you start to find yourselves in a market where, yes, entrepreneurs are being backed with high headline prices if they demonstrate that they are trying to tackle a huge market opportunity that could deliver an extraordinary return. But at the same time, we're in the business of taking risk. And if you get it right, you absolutely need to be rewarded with the risk that you're taking. And that is where hopefully we can find that middle ground with founders and entrepreneurs who recognize that they want thoughtful investors who understand the asset class, who understand what it takes to help build high quality fintech businesses. And that is kind of what we bring to the table. We understand the asset class, we have a strong portfolio, but also we have a team of people that have been operators, that have been entrepreneurs. We know what it takes, we know what the characteristics are. And guess what? We know how hard it is to navigate downturns because we've operated businesses several times over the years in different downturns. And I think that is also an important feature in the environment that we find ourselves in now. So I think I have exhausted all the questions that have been asked, and some really good questions as well. Please do visit augmentum.vc if you'd like to review the presentation in a little bit more detail. And thank you again for taking the time to listen to me, and look forward to seeing those of you that will join us again at our next check-in in our year-end results in the new year. And I will pause there and get back to Alessandro.
Tim, thank you very much for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Augmentum FinTech PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.